Mike, you and I have had quite a bit of discussion here about what you believe to be a firm late cycle event happening in the U.S. stock market and economy. Did last week's numbers confirm that? How they fit into the thesis?
Well, I think, good morning, Oliver. I think when you look at all of this in context, the macro environment doesn't look too bad. And if we look at it just over the last 12 months, what a difference a year makes. Because if you look at last time this year, the Fed was increasing rates, not decreasing rates like we're in the type of environment we're in today. PMIs 12 months ago were in the 50s. They were in the high 50s, approaching the top 5% ranking ever for global PMIs. In my opinion, that was the time to be fearful because we were just heading over the top of the roller coaster. And we saw the pullback and a retrenchment. And year to date, then you've seen this rotation from growth to value. You've seen some of these growth stocks and some tech stocks pull back a little bit, and they're trying to retrench. And there's a battle going on right now between growth and value. I think what you're also seeing is there's a trade war, and that's the major issue holding back the markets in a trading range. And until we get that resolved, we're going to stay in that range-bound trading range. And admittedly, then, when you drill down even a little bit further, you look at investing, it's all about earnings. And investors need to start shifting from defensive sectors like utilities and staples, which are up 20, 30% year-to-date, into more cyclical sectors like energy.
So, Michael, so far we've seen is that energy can't hold a bid, at least crude oil, above $60 for more than a second, even after one of the biggest attacks on Saudi, oil fields in history. What is that telling us from the energy market when it fades so quickly? Is that a reflection of demand, though?
I think it's a reflection of the market psychology. In other words, the markets, investors, institutional investors and some retail, but institutional investors overall looking at weaker global manufacturing. They're looking at trade activity and seeing the signs of the trade activity just slowly abating, but still it's caution. And oil being the largest, most liquid commodity in the world, it remains to be seen whether any types of policy easing measures are going to be sufficient to incite any kind of sustained rally in crude. What you're seeing is this risk on, risk off mentality. And admittedly, if you look at the economy, because really that's an indicator of what's going on with things in the oil markets, U.S. is late cycle right now.
Now, Michael, for investors that have been watching the rest of the world's numbers get worse for the last 18 months, the U.S. really now showing cracks in terms of our own economic data. In your mind, what does that contribute to whatever sort of portion of the cycle that we're in? Does it make things even more concerning, or does it suggest that maybe the U.S. being the best house on the block getting worse means the other houses might start to improve? I mean, are we just kind of the latecomer to slowness?
Well, I mean, that's the great question. And I think you're keen, you pointed that out, and a lot of investors are keen to figure out, is it the question of, are we the best house on the block? I look at it as quality. And right now, the U.S., both fixed income and equity market, has been some of the best quality and flight to quality play that a lot of investors have been hiding out. And admittedly, you're seeing China's numbers are bottoming. You're seeing some of these other numbers in Brazil and other places in emerging markets. They're just starting to bottom. And admittedly, the U.S. has been fighting the good fight, struggling to stay away from that economic slowdown. We're decelerating. I don't see a significant recession. I see deceleration. But that being said, with investors, I think you need to take a look at each geographic region and sector and look at the maturing business cycle. Asset class patterns are becoming less reliable. Why? We've had 10 years and two major market events, but 10 years of massive QE that's distorted the market. So I think, admittedly, investors need to take more of a cyclical tilt in their portfolio, a little bit of energy, a little bit of gold, a little bit of emerging markets, trying to play some of the opportunities in Europe. And admittedly, I think those are the places in energy and gold in particular where you can actually have some arbitrage on this global monetary easing cycle, as well as the asset valuation or asset distortion cycle.
Mike, what I'm curious about from the asset distortion side is we've heard this explanation for a long time, and sort of this view that monetary action was, inflating asset prices, yet we've continued to be in a run. We've continued to have earnings growth support a market that now gets choppy when we're trading at, 19 times, 20 times trailing, but still hasn't really shown the hallmark hallmarks of rabid speculative bubbles. So why does this time different? I mean, why does this time break the camel's back if there is indeed some, distortion of asset prices? I mean, where does that come from? Where's the evidence that one can capitalize on that if it hasn't happened for 10 years?
Well, so that's another great question. And when you look at both the macro and the fundamental perspective, what you're seeing is we've had a bunch of these mini pullbacks, these mini crashes, flash crashes, if you will. But you've seen things, whether it be the Mnuchin market massacre of December of last year, which really caught people's attention. And admittedly, in 2018, you had 2 or 3 of those massive pullbacks of anywhere from 5 to 10%, and then the market retrenched. This is part of the market telling itself it needs to get better. It's almost like when you're pulling someone off of some kind of for lack of a better phrase, you're pulling off a drug addict off of opioids, right? We've had the patient on significant amount of morphine, to use a different analogy. Trying to get it better, you need to wean them off the morphine, and it's a violent process trying to get someone sober, trying to get the market sober, weaning it off QE, and now we're going back to this process of leaning in, and the Fed's leaning into QE once again. I think it's not healthy. So what you're going to see is fits of volatility. You're going to see uncertainty in terms of trading volumes, in which some days will be light, some days will be heavy, and you'll see the complexity and ambiguity in the market in which asset allocation matters, valuation matters, picking your spots matters. And so to your point about what makes it different this time, it's not different. It's just the way that it's expressing itself is in a very different manner. And so I think if you've seen this over the last 20 or 30 years, you've seen other full market cycles, you can identify spots in valuation in which you want to pick your entry points, and whether that be in places like gold or places like energy, and admittedly run your charts and take a look at places like gold and energy in which you can enter a point and then create your asset allocation models.
Mike, what I'm trying to figure out is when we have now, to your point, I mean, last week, I described it here as being a pretty egregious statement by the market to rally so hard after we missed the ISM services, when the narrative coming into it was, let's hope we don't miss the ISM services after missing the ISM manufacturing. And markets jumped as the Fed cut possibility came in to view. So, I get it there, because in this case, the economy and the numbers really starting to soften. So it seems like maybe investors are getting a little carried away here with the concept of this kind of Fed put. But still, even with the last 9 months, what we've gotten is a Fed turning around and enough stability, or enough combination of low rates that possibly have helped the housing market, probably, as we see those numbers improving. We've seen an overall loosening of conditions where equities still have been able to stay afloat. Do you want to try and bet against a playbook that, even though you might think something's wrong with it, so far has worked like every time to keep stocks at decent elevations?
Well, so when I look at that, the move to global monetary easing once again is starting to boost asset valuations. You're seeing it's providing support for financial conditions in the near term, i.e. 3, 6, 12 months.
Okay.
But you're seeing heightened trade policy risks, a multitude of economic headwinds, and that has the possibility of blunting the monetary easing, and that's creating this artificial sugar high, the artificial stimulated growth. So I think from here, you're looking at these markets. There is no alternative. You cannot fight the Fed, whatever phrase you want to use, but you need to stay constructively invested, stay in the market, and keep a close eye on what's going on day to day, week to week, month to month. You can't take your eye off the markets these days. Mike,
quick question on the gold and the energy side, just to come back to the way you put this into work right now. It seems like gold both has been moving on those expectations for increasingly lower rates, more negative yields around the world, but also on some of the economic concerns, as have bonds. So when I think about what's driving gold and what could potentially drive it back to new highs, as we were talking about, is that the same set of events that's going to help out an energy sector that's a little bit more cyclical? I mean, would gold not come under pressure in a market where there's enough cyclical demand to drive energy prices higher?
I think they're not mutually exclusive. I think you can see gold participate and you can see energy participate in the upside meaningfully, particularly in an artificially low interest rate environment where we're heading. It appears to be heading again. And if you look at valuations on energy, they're exceptionally attractive. You're talking a deep value asset class. gold is a little bit different in the sense that the dollar softens, gold gets a trade. You're starting to see more negative rates around the world, gold gets a trade. You're starting to see more geopolitical risk, gold gets a trade. So they're two different independent asset classes that both have their merits in investor portfolios. That's why we have in some of our portfolios more than 10% in gold allocations, and in energy we have significant 20-30% allocations across institutional portfolios.